the life market here at Dunhill. We're doing our 2025 year-end tax roundup. And so there's a reason why we have been presenting tax strategies to everybody over the past few months. And it is one of the stalwarts of truth in annuity and life insurance sales. It has never failed, it probably never will fail, is that all of the largest cases, the largest plans, all revolve around tax planning. So we teamed up with Jesse Lipscomb from Roadmap Tax, and we wanted to just do a quick year-end summary. We're going to look at some opportunities that you can present to your clients for 2026. We're going to talk about some tactics that can be deployed and employed immediately in 2025, some optimization strategies. And then we're going to talk about some kind of the changing landscape, if you would, that we can expect in 2026. So we want to show you guys opportunities that are semi-immediate. We want to make sure that you're very aware of the opportunities for next year so that we're not missing the boat sitting here next December going, oh man, we could have, we should have. Let's turn next December into we did. And with that being said, I'm going to hand it over to Jesse Lipscomb. Jesse, welcome. Thank you.
Hey, thanks again. All right, guys. Hey, thanks for being with us here. We're talking tax. We're going to go fast and furious. Caveat, because it's so late in the year, a lot of the strategies that I'm going to share with you may really benefit you personally, but we also, for your business owner clients, they can benefit from it as well. So let's take a look here real quick. We're breaking this into two sections, basically 2025 year-end, 2026 opportunities. And for 25, really all we have left, tax bracket optimization and tax deferral. The definition of that is we're just trying to figure out what tax bracket people are in. You see how, hey Josh, let me see if we can get rid of that. There you go. Okay, there we go. All right, so you see how the tax brackets start 10%, go up to 37%. Most people are talking about their AGI. AGI is not what you pay taxes on. We want to know, hey, how do we get out of the 32% bracket? How do we get into the 12% bracket? Well, if you are in the 12% bracket, making, say, $100,000 a year, $96,000 a year taxable, to me, that is mathematically the area that you should be doing Roth IRA contributions, okay? Additionally, if you're in the 22% tax bracket, 401k salary deferrals and employer contributions, that you're going to save, in California, you're saving 31 cents on the dollar doing that. And then ultimately, you've got your defined benefit plans when you're in those really high tax brackets, 32, 35, 37. Regarding tax deferral, all employer-sponsored retirement plans have employer contributions, okay? 401ks also give you employee salary deferrals, but on the employer side, you have until September 15th of next year to make a contribution to lower this year's taxes if you're an S Corp. If you're self-employed or a C Corp, you actually have until October 15th of 2026 to lower 2025 taxes. So let's take a look at the 401k side. Again, salary deferrals and employer contributions. Most people self-employed look at the SEP IRA as, wow, this is great. It's the self-employed IRA. Well, that's actually not true. It's technically a simplified employee pension, which means in government speak that there is a complicated employee pension out there, which there is, called a defined benefit plan. But if you look at it as solo 401k versus a SEP, the employer contribution is exactly the same. If you're paying yourself wages, it's 25% of the wages, whether it's a 401k or a SEP, same. The 401k, however, will allow you to do salary deferrals. In 2025, that can be as much as $31,000 if you're over 50. But look at this, 72 grand to put away 48,000 versus 72 grand of wages and 18,000. In lower wages, it's actually even more powerful because a SEP IRA can only put away 25% of 24 grand. It's only $6,000. Whereas with salary deferrals, you actually can ultimately put 100% of your wages into the 401k as an offset. I found this works really great when you have one spouse that is, W-2 making pretty good money, and the other spouse is self-employed, maybe an S corporation. Maybe they're making $60,000 or $70,000 net total. So we put them in a $24,000 salary, the rest S corp profits, but now we're putting $24,000 away. It's a really nice a way of saving for retirement. Now, speaking of the solo 401k, this is branding, this is marketing. Okay, a 401k is a 401k. You need an adoption agreement, you need plan docs, you need all that stuff. But a lot of times you can get them directly from the custodians like Schwab as templated, ready to go models. Okay, the 401k, if you're an owner only, you're the only employee in an S corporation or a C corporation, or you're self-employed and don't have any W-2 employees, you are eligible for a solo 401k. And everybody can do $23,500 of salary deferrals. If you're over 50, you can do an extra $7,500. If you're in this window of 60 to 63, you can add in $11,250. And as an employer, your business can still put in 25% of wages. So here's something interesting for 2026. This starts January 1st. If prior year wages are $150,000 or more, all age 55 plus catch-up contributions now have to be made into a Roth. Okay, so that interestingly, if you're in charge of your own wages and you want to do catch-up contributions, $149,000 salary. Okay, that's a little nuanced, but it's nevertheless important. Okay, now we're talking about the defined benefit plans. Remember earlier the SEP IRA, the simplified employee pension? Well, this is the complicated employee pension. Okay, this is designed to allow a business to really provide massive tax savings. Okay, let's just compare this to a 401k. Here you do have somebody paying $150,000 a year, and they've got $27,000 in salary deferrals, and the 401k employer contribution 25%, $37,500. $64,000 into a 401k is a big deal, but it's nothing compared to the $200,000 you can put away if you have a combination 401k and defined benefit plan. You get salary deferrals. The 401k employer contribution gets scaled down to 6%, but typically you can put between 100% and 150%, sometimes even up to 200% of your wages into the defined benefit plan. And I mean, just as a matter of perspective, that $200,000 total 401k contribution, defined benefit plan contribution, is saving $76,000 in tax savings. It's huge. If you just did this for 5 years, you'd have an extra $1 million set aside for retirement, plus earnings, and having saved a substantial amount of money in the process. So as we transition now into 2026, okay, I'm offering all of you, the audience, the opportunity to begin offering strategic tax planning services and setting up partnership with us. And what I mean by that, strategic tax planning, tax bracket optimization, tax deferral, utilizing leverage depreciation and charitable arbitrage. These are the strategies that will help your clients take control of their taxes, pay less taxes, potentially lower and or eliminate those taxes. And what happens in that situation? They have more wealth to manage. And you guys are the experts in that. So if we look at tax deferral, it's more than just retirement accounts. It's retirement and real estate. Okay. When we look at the retirement accounts of it, pre-retirement, you have IRAs and 401ks, defined benefit plans, all that stuff, right? Your long-term tax deferred retirement plan savings. Once you are retired, utilizing systematic Roth conversions, strategically designed to keep you in the lowest bracket possible and potentially offset. Here's a quiz. Okay. What is the number one reason why Roth conversions fail, or at least don't make sense for most people? And No hands, I'll just tell you the answer. Okay, the there we go. It's because we have progressive tax brackets, right? We talked about this earlier in the optimization, 10, 12, 22, 32, 35, right? Okay, the more money you convert from an IRA to a Roth IRA, the higher the taxes are due. That's why. So you can't take your $1 million IRA and turn it into $1 million Roth without being injured tax-wise. However, systematic conversions might offer a wonderful solution. So first of all, there's the 461 limit. That is the excess business loss limitation. It's $626,000 married, $313,000 single. So let's just easy math. Let's say 600 if you're married, 300 if you're single. Okay. We can utilize depreciation related business losses to offset the income taxes in a process called leverage depreciation. Okay. The old IUL joke, an IRA is an IOU to the IRS. Well, when you do a systematic Roth conversion and you offset the income utilizing leverage depreciation losses, that IOU can become zero, and that's pretty awesome. So real estate, 1031 exchanges are a great accumulation strategy. You've got rentals, second homes, primary residences, and you want an exit strategy. Section 453 installment sales specifically. Structured installment sales are a great way to defer those taxes. And again, sometimes we can defer those taxes, use leverage depreciation, get a loss here, income there, and then wipe out those taxes via tax balancing. So what is this leverage depreciation I keep talking about? IRS Pub 946. Depreciation is just a wear and tear allowance, right? It's an allowance for wear and tear, deterioration, obsolescence. Okay, you hear a lot about there, especially with the Trump tax reform 25. We've got 100% bonus depreciation back. That's section 168K. But whether we do straight line depreciation or accelerated, either way, depreciation is just a tax loss. It's not a real loss, but you can use those tax losses to offset income. So most commonly depreciated assets, vehicles, equipment, real estate. I mean, one last minute tax break. If you guys buy a car at the end of the year, we could buy a $50,000 car, accelerated depreciation, you got a $50,000 deduction. However, I don't want you going into debt and buying a car unless you need a car. Make sense? Okay, so TB says, will we get a copy of the recording? Yes. Josh says, absolutely. All right, so here we go. The IRS allows depreciation of the total purchase price regardless of whether you pay cash or credit. Okay, on that $50,000 vehicle might not really matter, right? You can pay $50,000 cash or you can finance it. But if you bought $1 million rental property, most people aren't going to bring in $1 million. They're going to put some amount down and then they're going to acquire that asset. Well, the point is, credit can leverage larger assets with greater depreciation deductions than you have available cash. That's the key. Depreciation is good. Leverage is good. Leveraged depreciation is great. Okay. And again, this slide discusses exactly what I said earlier about section 461. Specifically, depreciation can create tax losses, which can reduce your business profits to zero. And then you have an additional 600,000 or 300,000 to offset other income. Okay. Really, really important when it comes to this strategy, it's material participation, which is key. Okay. That means you participate more than 100 hours in the business. Nobody else does more than you. You break that down to 2 hours a week working in or on your business in a single member LLC, no employees, really clean and easy. But without this, without hitting the material participation standard, the IRS might consider this a passive activity, which makes it fail. Okay, so let's look at an example. End of the year, you go to the RV dealership, you buy a $300,000 Class A motorhome, new or used, and because it's December 17th, you're not going to get your first payment until January. You won't even make a payment on this until next year. Okay. But if you can spend 2 hours a week leasing it out via RV share or outdoorsy or whatever, okay, your rental income should meet or exceed your expenses, including the loan payments. And then you're going to get a $300,000 depreciation. Well, if you took that $300,000 depreciation allowance from the leveraged depreciation, and you were making, $600,000, $700,000, $800,000 a year, well, you're going to save anywhere from $72,000 to $111,000 in taxes. Or you're 60 years old, you're thinking about retiring in 2 or 3 years. You take $300,000 out of your IRA, roll that and convert it to a Roth IRA. Get $300,000 of depreciation from acquiring the RV, 300 up, 300 down, 0 taxes, and maybe in 3 years you're tired of renting it out and you guys get to RV around the country. You don't have to be in business forever.
If you keep it for 5 years, you don't have to deal with recapture.
Maybe. Maybe. All right. So charitable arbitrage, this is a Jesseism. I kind of made this up, right? And when I say made it up, I mean to say the phrase, the idea is not my idea, it's pretty awesome. All right, what am I talking about? Charitable limits, you got 60% of AGI, 30% if it's not cash, and you get, the qualified charitable distributions on the IRAs have gone up. In 2026, they're needling you a little bit because now there's this 0.5% floor personal, 1% floor to corpse, but it's irrelevant, right? It's 60% of your AGI can be contributed to charity, right? Whether you get a full benefit or not, those are the rules. But let's take a look at somebody making $1 million a year. Okay, they can give $600,000 to charity, and utilizing our tax software, we're going to see that they save $211,000 in IRS taxes, almost $70,000 in California taxes, so almost a 47% tax. Okay, what's the problem? The problem is not that somebody's not on mute. The problem.
Can you mute your microphone, please?
The problem is that it's expensive tax savings. Okay, because you just spent $600,000 on charity, you saved $281,000. But you really, that's $318,000 you no longer have to enjoy. And that seems like, if you're committed to charity, it's wonderful. But if you're just doing this for taxes, it seems really, really expensive to me. Okay. So I'm going to make a very small pivot, but hopefully you guys can track with me here. You're going to go to Costco. You're going to buy a $100 Starbucks gift card. It's $100, right? Costco's going to sell that to you for $80. You figure they bought it for $70, they're profiting $10. And Starbucks gets that $70 that Costco paid them, and they have a $100 liability because it's a $100 gift card. The question is, what is that gift card worth? You bought it for $80, gift card's $100. Well, it's still worth $100. It's worth $100 regardless of how much you bought it for. You can get $100 worth of goods when you go to Starbucks. Okay. What if somehow, some way, you could partner with Starbucks? What is their true cost on that $100? Maybe $20, right? Coffee and rent, employees, whatever. And so if you start thinking like that, here's one of our strategies. You can partner with a supplement manufacturer. Okay. Their pure cost of the supplement is going to be about $20. But the face value of a gift card is going to be $100. And we'll have that, we'll get a qualified appraisal to appraise the true value of that gift card. And so now you acquire something at $20 and you donate it at $100 because gift cards are considered a cash equivalent. Let's take a look at the same numbers. Again, same $1 million, same $600,000 cash limitation, but a fifth of that's only $120,000. Now you're giving $120,000 to go into the partnership, and having that partnership donate $600,000 in gift cards. It's going to save you the same $281,000. Well, that's irritating. All right. It's going to save you the same $281,000 in tax savings, but it only costs you $120,000. So there's your arbitrage. You spent $120, you saved $280. You've got $160,000 that you would have lost to taxes. Okay. And so that's pretty cool. All right. Let's see. Strategic tax planning and roadmap here. We've got the recap of what we're just talking about. And I'm not sure if I can, nothing we can do about it. All right. Sorry about the phone call. The four things in strategic tax planning is tax bracket optimization, tax deferral, leverage depreciation, keeping in mind the 461 excess business loss limitations, and the $100 material participation standard. Now we got charitable arbitrage. These are four strategies that you really should look at working with your clients in the new year. Save your clients a lot of money in taxes. Okay. Take those tax savings, which is pure money. Like it's not even after tax money, it's tax money, right? And then utilize that to increase your client's wealth. Okay. Some of the solutions that we have are structured installment sales. So again, selling a rental property, instead of paying taxes over 1 year, maybe we do 3 to 5 years. And in those 3 to 5 years, we offset the income with leverage depreciation. Using our systematic Roth conversions with depreciation, that's going to give your clients tax freedom. We've got several ready to go business models. Instead of having your clients go out and buy that RV, they can take a look at some of our ready to go business models, which come complete with cash flow and leverage depreciation. And then again, our charitable arbitrage.
So let me ask you something,
Yeah.
Jesse, on the ready to go business models, because I want to make sure that this is abundantly clear. Roadmap has every step of the way pre-paved for them when you say ready to go.
Yes.
Meaning you guys can help them set up the LLC. You already have business partnerships and widgets of any kind to purchase that are going to generate revenue.
Yeah.
And 10-to-1 leverage, 6-to-1 leverage. What are we looking at?
Yeah, I mean, we've got a lot of different programs. I'm a member of the largest peer-to-peer community of tax strategies in the country. And we get together on a monthly basis and basically compare notes and see what's working and see what's out there. Each strategy isn't going to be a perfect fit for any one person. But the core concept, the fundamental concept of leverage depreciation and cash flow, I mean, think about this. One of the strategies we had last year was on OBS. What's OBS? It's a off-balance sheet assets. Okay, and I know that's an accounting term, but everybody on this Zoom knows about it right now. I know you do, because if you've ever used an Airbnb or a Turo or even that RV share I was talking about, all of these are platforms. Okay, Airbnb doesn't have any houses,
right?
Okay, Airbnb is a platform that allows the owner of an asset to utilize their asset on the platform. Now, it's good for the owner. They're getting cash flow. It's good for Airbnb. They're getting fees. It's good for the person staying there because they don't have to stay in a hotel. Everybody wins. And in our ready to go business model, same thing. They're just plug and play. There's going to be the acquisition of an asset. Sometimes client has to qualify for it with regular bank financing. Sometimes there's seller financing. Just really depends. But you acquire the asset with leverage, and then whether it's a lease back or it's a rent back or whatever, you get the cash flows coming, and those cash flows allow you to satisfy the economic substance principle, and B, to get the depreciation. Yeah, it's great, TV. That's a great question. So the risk of an audit. Let's start there. Okay. All of us waking up in the morning have a 1% chance of winning the audit lottery. Okay. And what I mean by that, I mean, that's just our odds. Okay. When we look at fundamentally sound strategy, the strategies themselves will not increase your odds of getting audited. And let me explain. That RV share strategy I shared earlier, how's it reported? It's reported on Schedule C. You claim your income, you claim your expenses, you list your assets, you get the depreciation. It's very boom, 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 boom. Now, some of our partners will actually have built-in audit defense, right, inside of their programs. Other times, like the charitable arbitrage, you're getting third party. Your client gets a K1 from the partnership that flows directly into their own Schedule A itemized deductions. So in the case of an audit, the IRS is just going to look, well, that's your K1. If they want to audit the partnership, well, that's on the partnership. It's not even on the client.
Well, another thing to add, Jesse, in this, and especially in the ready to go business plans, and you and I have sat down and talked about the charitable arbitrage and the mechanics. We've talked about the leverage depreciation, and one of the things that really stood out to me is that a lot of those those plug and play business plans that you have, they have income protection contractually put in place for your clients.
Yeah.
So, they're the protector. That's why when I saw your question, I'm like, oh, this is great. This is something we haven't touched on.
It's awesome.
And it just adds credence to these plans. Now, to bring it back to the audience of insurance and annuity professionals, some of you have seen the prior webinars that Jesse and I have hosted, specifically on the depreciation. Some of you haven't. So we're going to do a 30,000-foot view for the right client. Hector, can you please mute your phone? For the right client, Jesse is able to drastically reduce or eliminate income tax in the right scenario, the right structure, right? We're talking for, very highly compensated employees, business owners that are making 300 AGI of 300, 400,000 a year. Jesse's able to really change their financial landscape with that. The charitable arbitrage, if you're making $1 million and I can retain an extra 168, well, that's great. Now, the question that I pose to you guys as insurance and annuity professionals is, if you can find me an extra $168,000 a year, can you convince me to throw $75,000 of that into a financial product that's going to benefit me even further? My assumption is absolutely you can. Your sales professionals, your advisors, your tacticians, your planners, right? Now, with the leverage depreciation, if you can put $300,000 in my pocket as your client, am I going to be more willing to drop $100,000 into some future planning with you? Yeah. So these tax strategies that Jesse is teaching and exposing you to, what they really are opportunities for you as an advisor to add value to the conversation. You can now have a very deep toolbox that will put you in front of high net worth clients with a value to them in a favorable manner. Anytime we sit down and talk about money, I could meet you at a hotel bar in Scottsdale at a conference for medical equipment, right? What's the scuttlebutt around the room? Oh, how are you doing? Oh, I'm doing great. Yeah, oh, great. Except for taxes, right? It's in every room I've ever been in with anybody that makes any money. There's a solution here. You can turn those solutions into opportunities.
The one bullet point I didn't put up here is also being able to offer defined benefit plans and 401ks. I mean, that's pretty cool. Offering those TPA services, that I've seen that helps so many clients. But all right. Last section here is the power of partnership. Okay. In order for you to effectively position strategic tax planning, what do you need? Well, you need a tax license. passing, right? How many of us have been in that situation where, we've been told, hey, look, financial advisors can give financial advice, tax people can give tax advice, but there's no overlap, right? So that's what we're offering you the opportunity to partner with a tax firm. We are all licensed enrolled agents, licensed directly by the IRS. You got to have the right software. You got to have the right deliverables. We utilize the Core V tax planning suite. It's a robust multi-entity simultaneous tax planning model, which means that we can take a look at the personal taxes, business taxes, rental taxes. We can run the scenarios, figure out where their tax bracket is, and figure out how our tax strategies can mitigate those taxes. And again, having deliverables where we give them the actual tax calculators and the tax planning report. It's literally, this tax planning report is so wonderful because it actually goes in per section and says, okay, the 401k contribution is saving you $20,000. The defined benefit plan is saving you $180,000. The leveraged depreciation is saving you, $200,000, whatever it is. Okay. All right. At the bottom line, this is an opportunity for you guys to have multiple streams of income. Look, I don't want any of your IUL or your annuity commission, your AUM. That's your money. It's your client. Okay. But if we can help them save money in taxes, we're entrusting you guys to position the financial products, solutions, and to benefit from that as well. Plus, we'll give you 5% of the capital when they implement our ready-to-go business models, or 1% of the capital when they go do a charitable strategy.
Tony, I made coffee if you want, the special.
I'm okay. I don't need coffee. All right.
Okay.
So if you're interested in providing a strategic tax plan with your clients, you can bang that QR code, or you can just send me an email directly. Josh, you have any closing thoughts?
Yeah, definitely. I encourage you guys to either reach out to your life marketer for more information, or directly to Jesse. Reach out to your life marketer for the additional planning, the annuity planning, the life planning, whatever it may be. Again, I cannot stress enough, the largest cases in our industry revolve around tax planning. And now you all have a roadmap, and an opportunity.
Yeah, that's awesome. Like I said, we have a team of enrolled agents, myself included, that are solely focused on helping design and implement strategic tax plans. So, hey guys, you guys have a great holidays, and we'll catch you in the new year.
Yeah, thank you very much, everyone. Thank you for joining us, taking time out of your holiday. Thank you for being understanding about the technical issues earlier this morning. We will be emailing a copy of the video out to everybody. Happy holidays. I wish you all a very prosperous 2026. Thank you very much.
See you.